finally, the much-awaited company that everyone was waiting in the FMCG space, the most spoken about in the recent times, that Honasa Consumer Private Limited, parent company to Mamaearth, has finally listed on the exchanges. And today here I am at the NSE, and with me is Varun as well as Ghazal. Very good morning and thank you so much. Firstly, congratulations for the listing. You know, I'm sure y'all are feeling great because I heard your speech before as well. It was very emotional as well. So firstly, thank you so much and a big congratulations to both of y'all. You know, I want to start by finally a listed company so I can ask you more questions. And I'm going to ask you, you know, just in general, let's talk about the market trends. Because FMCG companies, beauty personal care segment, can you tell me how is the demand trend currently in that? What are you seeing in terms of shaping up for the company? Where do you see that growth strategy coming in for the company?
So I think first of all, Honasa Consumer Limited,
not private,
not private anymore. That's what we are starting our day with. Super excited, super happy, a lot of emotions. We have finally done it. As far as I think the company and the space is concerned, beauty and personal care is a segment that we are very, very excited about. Personally, you know, that's what Honasa plans to cater to in the longer run as well. We believe that this is the segment which is growing really fast, largely driven by, you know, women joining more workforce as a trend and income levels going up. And these are the two factors which we believe will continue to grow this segment even going forward. And we are placing our bet on Mastige as a segment because we believe that that's going to grow faster than the mass segment, and very excited to now start building for the future as well.
That's absolutely great. You know, I want to talk about that growth. Obviously, right now, our CAGR growth is going to be something much higher because we started, the base is lower as well. But at some point of time, where do you see yourself stabilizing? You know, would you be still expecting to grow better than the industry? Is that something we could expect, Varun?
Of course, right. Please expect that from us, right. Hold us to that, right, because we are a growth-oriented company. We see so much opportunity in building the right kind of products for consumers, and if you do that, consumers reward you, right? And we have continued doing that in this year, first quarter as well, where we grew ahead of 40% plus, right? And I think we will continue to strive to grow ahead of industry in the future as well.
So how was Q2 looking like?
Was
it looking similar as Q1? Could we expect that?
It was very good, better than industry for sure.
And festive season, you know, that does give a lot of pickup in terms of everyone starts going more shopping, whether you want to pick up anything related to beauty products as well. Is that a trend that you normally see in your business as well, that festive season or maybe a Q3, Q4 would be seeing a higher pickup given wedding season comes in as well?
So in our case, it does have skew for certain categories, like for example, some of the skincare categories or some of the color care categories do get some bump up, right? But overall, because we are present in all categories, right, be it summer categories or winter festive categories, right, for us half one and half two are largely in the similar space, so there is not much seasonality in the business.
Sure. You know, I also want to understand in terms of gross margins, you know, fabulous gross margins that the company has, much better than where I've seen in the FMCG industry. In these margins, how do you think, like, you know, you think this is a sustainable level for the margins, given that, you know, there are a lot of inflationary trends that we've seen the last couple of years because of COVID as well, and everything that shapes up. How do you manage to actually maintain these margin levels, Ghazal?
I think large part of our growth is actually volume driven. We have seen these gross margins when we started out as well. I think we've gotten better in the last 3 years. And yes, these are sustainable levels of gross margins. We will continue to see improvement in them as well. Yeah, I mean, I don't think that there's going to be like up and down when it comes to gross margins now.
You know, because we have a lot of contract manufacturers as well, right? So in terms of when you're having contracts with them, given this inflationary, deflationary phase that you see, you know, do our contract terms also keep changing because of anything in terms of the pricing, or, you know, how does that work out for the company?
See, we do see inflationary pressures. We have seen it in the past. That said, we have not needed to take a price hike up. We've taken it, I think, in just 2% of our portfolio. That is it. But other than that, we are because we have high gross margins, we are also able to cater to some of that. Like we work with our partners. We have very strong relationships. When we started out versus today, our scale has increased considerably well. So our terms with them also become better. And that's something that we believe is going to happen, continue to happen in future as well.
Absolutely. So gross margins, because we have so much of a space in terms of the gross margins, would at ever some point of time, maybe we would give up some bit of the gross margins and look at growth? Is that something as a strategy that we would look at, or would margins still be at this level and continue to focus on growth as well?
No, so from a gross margin perspective, this is the level at which we have operated in the past, and our attempt would be to continue to operate at that level. And I think growth at these margins are possible. We have demonstrated that in the past, and we'll continue to demonstrate that in the future.